Well, there's been a lot of talk lately about Trump's critical minerals policy possibly creating a once-in-a-cycle setup for silver. So in this video, we're going to separate the headline from the actual mechanics, and you're going to walk away feeling a lot smarter and a lot more confident about gold, silver, and platinum. And today is Tuesday, May 5th, New York time. So before we get into the details, comment what day and date you're watching from, because I want to see who is following this market in real time. Also, if you value this kind of breakdown, subscribe to the channel and comment John AG Best. That's the easiest way to show you want more research-driven analysis and less hype. So here's the claim going around. Silver has now been pulled into the critical minerals conversation. Copper, silver, and several other materials were added to the official list because supply disruptions could affect the economy and national security. And back in the broader mineral production order, the government defined mineral production very broadly, including mining, processing, refining, smelting, and related products. That matters because it means Washington is not only thinking about rocks in the ground, it is thinking about the whole chain. Now, on the surface, that sounds very bullish for silver. If silver is strategic, if the government wants secure domestic supply, and if the market is already tight, then maybe price has to move higher. Okay? That is the simple version. But the simple version is not enough. Because a government label does not magically remove ounces from the market. It does not instantly create a shortage. It changes incentives. And incentives are where the story gets interesting. Think of it like a line forming before the store opens. Nothing has been sold yet, but everyone can see people gathering. Industrial buyers notice. Traders notice. Mining companies notice. Importers notice. And before a real shortage becomes visible, behavior starts changing. That is why this policy matters. Not because it guarantees a straight-line silver rally, but because it tells the market that silver is no longer only a jewelry metal, or only a coin metal, or only something stackers argue about online. It is part of a supply chain conversation involving solar, electronics, batteries, grid equipment, defense systems, artificial intelligence data centers, and manufacturing security. Based on recently published numbers, silver has already been in deficit for several years, and the preliminary outlook for this year still shows another deficit, even with total supply expected to rise slightly. Industrial demand is not collapsing, but there is some thrifting and substitution in solar. Investment demand, on the other hand, is expected to rise strongly, so you can already see the tension. Some industrial users are trying to use less silver because prices are high, while investors are becoming more interested because the setup looks tight. And that is where people make the first mistake. They treat silver like one story. It is not one story. Silver is monetary, industrial, political, and speculative all at once. When the dollar weakens, silver can trade like money. When solar and electronics demand rises, silver can trade like an industrial input. When government policy gets involved, silver can trade like a strategic material. And when momentum traders show up, silver can trade like a rocket with bad brakes. So if silver jumps, people say, "This is it." If silver drops, people say, "The thesis failed." Both reactions are too emotional. Silver can be bullish long-term and still punish people brutally in the short term. That is not a contradiction. That is silver. Now let's bring gold into this because gold is the anchor. Gold had a powerful move, and it is fair to say it got stretched. Not broken, stretched. When a chart moves too fast, tourists come in. They buy because the line is going up, not because they understand debt, deficits, real rates, or purchasing power. Then, when the line stops going up for a few weeks, those same buyers disappear. So when gold pulls back while the dollar is firm and Treasury yields are elevated, that does not automatically mean the gold thesis is over. It means the market is testing who is actually committed. The 10-year Treasury yield has recently been sitting in the mid-4s. The Federal Reserve has also kept rates in the mid-3s target range, while saying Middle East developments have increased uncertainty and inflation is still above target. That combination matters. Higher yields can pressure gold today because gold does not pay interest, but higher yields can also strengthen the long-term gold thesis if they make government debt harder to finance. This is the part people skip. The federal deficit is projected to be close to $2 trillion this fiscal year and much larger by the mid-30s. Net interest costs are projected to keep rising as a share of the economy. So, if rates stay higher for longer, the pressure does not disappear. It moves from the gold chart into the federal budget. And eventually, the question may not be, what rate would fight inflation perfectly? The question may become, what rate can the system actually tolerate? That is a very different question. Now, does that mean gold must explode tomorrow? No, definitely not. And anyone telling you it has to happen immediately is leaving out the hard part. In major metals cycles, big drawdowns can happen inside the bull market. Sometimes the pullback is the test, sometimes it is the reset, sometimes it is just the market shaking out people who borrowed conviction from a green candle. So, I would not look at gold weakness and automatically say, it is over. I would ask a better question. Did the debt problem improve? Did deficits shrink? Did real purchasing power suddenly become safe? Did policymakers suddenly prefer discipline over liquidity? If the answer is no, then gold may still be doing its job, even if it is making people uncomfortable. Now, silver is different. Gold is savings protection. Silver is a hybrid. And silver stocks are another thing entirely. Physical silver is clean. You own the metal. There is no management team, no mine plan, no bad acquisition, no operating surprise. But if the metal goes sideways, your position goes sideways. Silver stocks can be more interesting, but also more dangerous. A good silver company can benefit from higher metal prices, better margins, exploration success, and a valuation catch-up. But a weak company can underperform even in a bull market. So when people say silver stocks are better than silver, we need to slow down. Better for who? Better at what price? Better with what balance sheet? Better under what risk tolerance? Here is the actual argument. If physical silver has already moved, but the quality silver equities are still priced as if the market does not believe the move, then the stocks can offer more torque. They can move even if silver pauses, because the discount closes. And if silver keeps rising, the operating leverage can kick in. But if silver falls hard, bad companies can fall harder. That is the trade-off. So the smart question is not, should I own silver or silver stocks? The smart question is, which job am I hiring this asset to do? Physical silver is for direct metal exposure. Silver stocks are for leveraged speculation. Gold is for savings protection. Platinum is for a different speculation altogether. And by the way, if you're successful, share your success story in the comments so others can stay motivated. A lot of people only hear about panic and losses. It helps when disciplined people explain how they stayed patient. Now, silver supply is also strange. A lot of silver does not come from primary silver mines. It comes as a byproduct from copper, lead, zinc, and other base metal operations. That means silver supply does not always respond cleanly to silver prices. If copper production slows, silver supply can tighten even if silver prices are attractive. If copper production expands, silver can come to market even when silver itself was not the main reason. That is why the critical minerals policy is so important. It highlights a system that cannot be switched on quickly. You cannot sign a paper in Washington and suddenly produce refined silver next month. Permitting takes time. Processing capacity takes time. Financing takes time. Skilled labor takes time. And communities do not always welcome new mining projects just because the federal government says they matter. So the policy could support domestic supply long term, but in the near term it may create more competition for existing material. That is the part traders are watching. Now here is the counterpoint. A critical minerals label can also reduce panic if it encourages more investment, more recycling, and faster permitting. If markets believe future supply will improve, the policy might cool the fear premium instead of expanding it. So we should not pretend every policy headline is automatically bullish. The timing matters. The details matter. The market's expectations matter. But even with that caution, silver has a cleaner long-term story than it had a few years ago. The world needs more electricity, more solar, more transmission, more electronics, more data infrastructure, more secure supply chains. And silver sits right in the middle of that. Now platinum. Platinum is not gold. It is not silver. It is a supply risk speculation. It has industrial uses, especially in catalytic systems and other applications, and a lot of production is concentrated in politically complicated regions. That means a disruption in South Africa, Zimbabwe, or Russia can matter quickly. But that does not make platinum a guaranteed investment. It makes it a conditional bet. If nothing breaks, platinum can frustrate people for years. If supply gets hit while inventories are thin, the move can be violent. That is speculation. Possible, not guaranteed. So putting this all together, how should we think about this precious metals setup? In my opinion, the important point is not that one headline changed everything. The important point is that the headline arrived after the market was already tight, after government deficits were already large, after interest costs were already rising, after industrial demand had already become strategic, and after investors had already started looking for alternatives to paper promises. That is why silver matters here. Not because a policy order creates magic, because it confirms that governments are now paying attention to something the market was already warning about. And if the next phase comes, it probably will not move in a straight line. Gold could pull back, silver could overshoot, miners could lag first and then catch up. Platinum could do nothing until suddenly it does too much. That is how these markets behave. So do not build your plan around excitement. Build it around roles. Gold protects, silver accelerates. Silver stocks amplify, platinum speculates. Different tools, different risks, different jobs. If you can understand that, you are already ahead of most people chasing headlines. And if you ever feel lost, come back to these questions. Is supply getting easier or harder? Is policy getting more involved or less involved? Are real rates relieving pressure or adding pressure? Are deficits improving or worsening? Are industrial users finding substitutes, or are they still forced to buy? And are investors calm, or are they finally waking up? Those answers matter more than one dramatic headline. So yes, Trump's policy may have helped trigger attention. Yes, silver's setup is stronger because the market now sees it as strategic. And yes, there is a case for a larger cycle in precious metals. But the opportunity is not in blindly cheering every move higher. The opportunity is in understanding why the move is happening, where the risks are, and which asset actually fits your goal. Because the people who survive these cycles are not always the loudest. They are the ones who know the difference between protection, speculation, leverage, and hype. One more thing. Watch the difference between price and availability. A price chart can look calm while buyers behind the scenes are changing their behavior. If manufacturers start carrying more inventory, if wholesalers stop assuming material will always be available, and if funds start treating silver like a strategic input instead of a forgotten metal, the market can tighten before the average investor understands why. That is not a prediction of immediate panic. It is just how small commodity markets often work. And do not forget the dollar side of this. If the dollar strengthens for a while because global investors want liquidity, that can pressure metals. But a strong dollar during stress is not the same thing as a healthy monetary system. It can be the cleanest shirt in a messy closet. So if gold or silver struggle during a dollar rally, that does not automatically defeat the metals thesis. It may simply mean the market is moving through the liquidity phase before it gets back to the purchasing power phase. There is also a political angle that people underestimate. Once a material is connected to national security, companies may become more willing to sign long-term supply deals, governments may become more willing to finance projects, and investors may start valuing domestic production differently. That could help miners. But it could also invite more regulation, more reporting, more public attention, and possibly more government influence over where material goes. So again, it cuts both ways. That is why position size matters. You do not want to be so small that the cycle does nothing for you, but you also do not want to be so large that normal volatility forces you out. Silver does not care about your feelings. It can move against you just long enough to make you question the thesis, then reverse after you are gone. That is why conviction without risk control is not strength. It is just another way to get shaken out. So if you are using physical silver, understand storage, premiums, and liquidity. If you are using miners, understand costs, jurisdictions, debt, share dilution, and management quality. If you are using gold, understand that it is not meant to entertain you every week. And if you are using platinum, understand that you are waiting on a supply risk story that may or may not arrive. That is the difference between owning a story and understanding a cycle. A story makes you excited. A cycle makes you prepared. And in precious metals, prepared usually beats excited. The goal is not to predict every candle. The goal is to recognize early when the market's character has clearly changed. And that is the real setup. This video is for education and market discussion only. It is not personal financial advice, and I am not telling you what to buy, sell, or hold. Use this as a framework. Check the facts for yourself, and make decisions based on your own risk, time horizon, and financial situation.